Welcome to RBC's Markets in Motion podcast, recorded April 15th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, we've got a lot to get through. 7 big things you need to know. First, geopolitical concerns are spiking at a time when stocks already seem due for a pullback. Second, the rotation trade has just gotten a lot more complicated. Third, companies have been keeping expectations low on earnings. Fourth, our valuation modeling suggests a modest downside risk to the stock market if we don't get cuts, and a more significant hit if we get more hikes. Fifth, small caps may be stuck in a holding pattern for a while. Sixth, Biden has closed the gap with Trump in betting markets. And seventh, U.S. equity flows have fizzled. If you'd like to hear more, here's another 7 minutes. Let's jump into the details. Number 1. Geopolitical concerns are spiking at a time when stocks already seem due for a pullback. One point that kept coming up in our meetings last week was that equity markets have a tough time pricing in geopolitical risks too far ahead. Recently, equity investors appear to have baking in rising geopolitical risk by buying energy, which has easily been the top performing sector in large and small in recent months. That seemed to change at the end of last week as the S&P broke below its early April low on Friday's close. We reminded investors last week that sentiment has been looking frothy on a number of indicators, including the weekly AAII survey, as well as CFTC's weekly net positioning data in U.S. equity futures. How bad could a pullback get? For now, our assumption is that it would be in the 5 to 10% range. The drawdown in the S&P that occurred last summer and fall ended up being around 10%. And typically, any drawdown beyond that involves a serious scare about economic growth. This assumption could change, however, depending upon how geopolitical risks play out and if the economic narrative takes a turn for the worse. Number 2, the rotation trade has just gotten a lot more complicated. One of the best questions we got last week was what the hot inflation data means for the leadership rotation in the U.S. equity market that seemed like it was finally getting underway. Our answer, generally we think higher inflation and fears over higher rates are good for the mega-cap growth stocks. Post-SVB, the large-cap growth value trade, as well as the performance of the top 10 names in the S&P relative to the rest of the market, have been moving more or less in sync with trends in 10-year yields. We think this is in part due to better balance sheets in the biggest cap growth stocks. But it's worth noting that other things besides rates and balance sheet fears could drive the rotation trade. GDP forecasts have been moving up quickly and stand at 2.2% for 2024. That's a little below average, but when GDP is trending above average, large caps and growth tend to underperform small caps in value. So a continued ramping of economic expectations could keep the rotation and leadership going. Rising geopolitical risks also benefit energy, an important though not terribly big piece of the value trade. Cross currents for the old leadership, much like the broader market itself, are simply complicated. Number 3. Companies have been keeping expectations low on earnings. Earnings actually didn't come up too much in our meetings last week, but it's still worth taking a moment to highlight our thoughts as 1Q reporting season gets underway. The setup for earnings is interesting to us for a couple of reasons. For one thing, the decline in bottom-up EPS forecast for the S&P 500 has been milder than what we typically see. Cuts to bottom-up forecasts are the rule, not the exception. Additionally, downward guidance has far outpaced neutral and upward guidance recently. This has allowed companies to meet or even beat expectations. Though we like this setup for the most part, we do remain a bit concerned that expectations for margin expansion in 24 may not pan out given the cost pressures many companies cited in the last reporting season. The anticipation of significant margin expansion is one of the key differences between the bottom-up consensus, which is tracking around 242, and our own earnings forecast of 237. Color on margins is one of the big things we're looking for in the weeks ahead. Number 4. Our valuation modeling suggests a modest downside risk to the stock market if we don't get cuts, and a more significant hit if we get more hikes. Following last week's hot CPI print, we've updated our valuation stress tests. As a reminder, our valuation model forecasts a trailing PE for the S&P 500 at year-end based on the relationship between the trailing average S&P PE since 1962 with trends in PCE, 10-year yields, and Fed funds, along with consensus assumptions about where each of those variables will be at the end of the year. We look at the projected PE in the context of both our own below-consensus earnings forecast of 237 and the bottom-up earnings forecast to come up with a gauge on where the S&P 500 could potentially be at year-end. When we bake in the updated views of our RBC rate strategy team for one cut in December, our model points to a range of 50-50 to 5,200 for the S&P. When we bake in a scenario involving no cuts this year and stickier inflation and higher yields than expected, our model points to a range of 4,900 to 5,000 for the S&P price. When we bake in a scenario involving more hikes this year and much higher inflation and yields than currently expected, our model points to a range of 4,500 to 4,600 on the S&P price. Number 5. Small caps may be stuck in a holding pattern for a while. In the aftermath of last week's hot CPI print, our views on small cap were in focus in meetings. We've liked small caps this year and were impressed last week that even with several very bad days for the Russell 2000, the RTY-SPX ratio didn't break its mid-November 2023 low. There's still a lot we like about small caps. Balance sheets aren't as bad as feared in our view. Valuations are reasonable versus history and cheap versus large. Positioning on the CFTC data isn't extended for the Russell 2000, as is the case for the S&P 500 and NASDAQ. Small caps also tend to outperform large caps when ISM manufacturing is picking up and when GDP is above trend. There are valuation and economic and positioning tailwinds for small caps, to be sure. All that being said, we think small caps need confidence in cuts to be able to outperform in a sustainable way, as small caps usually outperform after cuts. And that confidence seems like it's just a long way off at the moment. For now, our assumption is that small caps will stay in a holding pattern relative to large until greater confidence in a Fed easing path emerges. Number 6. Biden has closed the gap with Trump in betting markets. We've talked a lot about the shifting dynamics in the race for the White House over the last few weeks, so we won't spend too much time here. But it's worth noting, given how in focus the U.S. election has been for non-U.S. investors, that Biden is now tied with Trump in betting markets. As we noted last week, this challenges a key assumption of non-U.S. investors that Republicans will sweep this fall. Ultimately, we think it's important to remind investors that stocks tend to go up regardless of which party controls the White House and Congress. And finally, number 7, U.S. equity flows have fizzled. Something else that's worth a quick mention, U.S. equity funds are suddenly seeing outflows. Outside of the U.S., most major geographies also remain weak, though Canada flows have started to improve a little bit, getting less negative. Within the U.S., flows for large cap and small cap are both under pressure, as are all of the major styles. Passive deterioration is noteworthy, while active is holding up much better. At the sector level, growth and defensive sectors are generally seeing the worst trends, while cyclical and commodity sectors are seeing improving and/or positive flows. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.